The market is shifting. And if you're still sitting on the sidelines, waiting for the perfect moment, you're already late. Volatility isn't going anywhere soon. But underneath all this noise, something powerful is building. And today, at Stock Edge Analytics, we're breaking down 3 stocks I personally bought recently. 2 are additions to existing positions, and 1 is a brand new entry. As always, this is not financial advice. Do your own due diligence. Now, let's get into it. Stock number 1, Meta Platforms. Now, Meta Platforms has been on my radar for a while, and after doing deep research on this company, I personally decided to buy this stock, and today I want to show you exactly why I believe this is one of the best opportunities in the market right now. When fear was driving people to sell, the smart money was quietly loading up. Now let's talk numbers. At the start of April, Meta was trading at a forward PE of under 20 times. Let that sink in. One of the most dominant digital advertising businesses on the planet, priced like a slow-growing utility stock. I added to my position personally at a 19.1 times forward multiple. Today, it sits at 23.11 times. Still, incredibly reasonable. And here is something important to understand. The name of the game isn't just finding great companies. It's finding great companies at great valuations. Take Costco, brilliant business. But at a 50 times forward multiple, that's not investing. That's paying a premium for comfort. Meta is completely different. Here's what the numbers actually show. Revenue growth, averaging 20% per year over the past few years, and expected to accelerate in 2026. Operating profit growth, 61%, 48%, and 20% over the last 3 years. This company is growing and becoming more efficient at the same time. And on top of all of that, AI is already moving the needle for their advertising business, and that tailwind is only getting stronger. Now here's where it gets really interesting. Meta currently trades at a PE of 23.11 times, a $1.7 trillion business, still priced like an average company. The stock sits 40% above its 52-week low of $479, but the 52-week high was $796. That means there is still nearly 18% upside just to get back to previous highs. 86% of analysts covering this stock have it rated as a buy. Personally, I believe Meta crosses $1,000 per share within the next 18 months. And by end of 2026, Meta is projected to surpass Alphabet in digital ad revenue for the very first time. Do not sleep on this one. Stock number 2, Netflix. Now, Netflix has been on my radar for quite some time. And after doing thorough research on this company, I personally decided to buy this stock. And today, I want to break down exactly why I bought this and why I believe the recent dip is a serious opportunity. Now, Netflix recently reported earnings. Revenue grew 16% year over year, a beat. But net income came in slightly below expectations, and after earnings, the stock dropped more than 9%. To me, that was an overreaction and a buying opportunity. Here is exactly why the sell-off was overdone. First, expense timing. The company was front-loading expenses. That means higher profitability is expected in the back half of the year. The earnings miss wasn't weakness, it was a timing issue. Second, guidance sandbagging. Netflix has a well-documented history of setting conservative guidance and then beating it. In the last 8 quarters, they have missed revenue guidance just once. One time. So when guidance looks soft, experienced investors know exactly what that means. Third, Reed Hastings stepping away. Now, this was probably the biggest emotional trigger for investors. And yes, Reed Hastings deserves enormous credit for building Netflix into what it is today. But here is the reality. Boards set direction. Management executes. The current leadership team is strong, and Hastings himself expressed full confidence in them, which is a big part of why he felt comfortable stepping back. It's not ideal, but it does not change the trajectory of this business. Netflix currently trades at a PE of 29.92 times, just under that 30 times threshold. Market cap, $389 billion. And here's the opportunity. The stock is sitting nearly 30% below its 52-week high of $134. From its 52-week low of $75, it has already recovered 24%. Stock number 3, XLG ETF. Now, the third buy is a little different. It's not a single stock, it's an ETF. The XLG, Invesco S&P Top 50 ETF. Back in March, I was watching the market sell off hard, across tech, and really, across every single sector. And I kept thinking, some of these mega-cap companies are trading at valuations that make absolutely no sense. So instead of picking just one or two, I bought a basket through XLG. Here's what's inside. NVIDIA at roughly 13% weighting. Apple, 10.5%. Alphabet, around 10%. Microsoft, 8.5%. Amazon, 7%. Broadcom, 5%. Meta, 4%. Tesla, 3%. And Berkshire Hathaway, nearly 2.5%. Today, it trades at $59.48. That is a 42% surge off the lows. And it's sitting just below its 52-week high of 60/63. Those who bought the dip are sitting on serious gains right now. Sometimes the smartest move isn't picking individual winners. It's buying the whole basket when everything is on sale. So there you have it. 3 of my most recent buys. Meta, bought at a historically low valuation, 40% off the lows, and still going. Netflix, bought the earnings dip with full conviction. Risk-reward remains compelling. XLG, bought a basket of mega-caps during the March sell-off, 42% off the lows, nearly at all-time highs. Now I want to hear from you in the comments below. What have you been buying lately? And which of these 3 do you like the most? If you got value from this video, hit that like button. It genuinely helps this channel grow. And if you haven't already, subscribe to Stock Edge Analytics so you never miss an update. See you in the next one. Take care.